we had already covered in an earlier stage or an earlier seminar some cash flow issues and some the deferment announcement from HMRC. So I'll quickly go over those, and then what I'd quite like to do is kind of cover a few more practical issues that we're seeing and we've been asked about and we're dealing with clients. So let me kind of spend a little bit more time on that. So the deferment, as I'm sure most of you are aware and know, VAT payments that are due to HMRC between March and June of this year have been deferred until March 2021. So if you're due to pay anything on VAT returns or payments on account, you can automatically defer those. You still have to submit your VAT returns because the VAT returns are due under a slightly different rule, and you need to submit the VAT returns by the date that's shown on the VAT return, not the day you would normally have paid, because most people paid by direct debit and that gave them an extra 7 days. So be sure to submit the return, be sure to submit it by the due date shown on the return, not the date that would have accompanied the direct debit. Talking of direct debits, you need to make sure that you cancel your direct debit, because obviously if you don't and there's a payment due to HMRC, there's no guarantee that HMRC system won't automatically kick in and take it. So cancel the direct debit, but clearly once everything's up and running again and we're kind of back to kind of semi-normal, you'll need to reinstate the direct debit. The other thing I would kind of flag up is, and this is where an awful lot of not-for-profits are kind of falling in, is that their businesses, the income side of things has stopped, but they're still incurring expenditure and still incurring purchases. So I would encourage you to obviously submit your repayment requests as soon as you possibly can. If you think you're going to be on a regular repayment, it might be worth thinking about going on to monthly VAT returns, and that would just speed up getting the money in the door. That'll have to tie in with your current VAT period, so it may be that you have to wait a wee while, but it would still definitely be worth looking at. If you could maybe move on to the next slide now, Kieran. We're looking again at the kind of the surviving mode, cash flow. And as Kirsty was talking about before, there are certain things you can do to make sure that you improve your cash flow and get into the most positive position you possibly can. The first is time to pay. Again, if you've got any payments that are due to HMRC which fall out with the period, the March to June period that I've just mentioned, ask to defer those if you can't afford to pay them. Just be sure that the deferment terms are realistic, because if you don't meet the deferment, the payment terms that you agree, it could be that HMRC raise assessments and ask for everything to be paid in once. If possible, try and accelerate repayments. So again, I was talking before about, if you find that you're going on to regular repayments, this often happens when organisations do a lot of construction work, and they find that their VAT payment position goes into a regular repayment. And if that's what you find yourself in, you can ask to go into monthly VAT returns if that helps you and if that's cost effective to do so. Third point is input tax accruals. If you've incurred purchases or you've paid for purchases, but for whatever reason, we saw an interesting one recently where people working from home weren't able to access invoices or access all the information on purchases, you can make accruals and you can write to HMRC or notify them that you've made an estimated claim. Perfectly acceptable. Clearly, if you've made an estimated claim, you need to make sure as soon as possible it's refined and corrected, and you'll need to notify HMRC, but it's worth doing again for cash flow. And we had one recently where a client couldn't get their hands on all the purchase invoices because their suppliers weren't sending things out maybe as actively and as accurately as they should have, and they had been paying money on direct debit and standing order kind of payments. So they knew how much had been paid, they knew what the VAT was, and they made accruals accordingly. And again, writing to HMRC to confirm those is a method that's and a route that's available to you. You can defer paying output tax over. So ordinarily, if you raise an invoice or you receive a payment, that's when you have to account for VAT. If you raise the invoice, there's no guarantee that you're going to get that payment as quickly as you normally would, or indeed for a while. So rather than creating that VAT liability or that requirement for you to pay money to HMRC, you can raise requests for payments, you can raise pro forma invoices, you can raise demands, documents which aren't fully VAT invoices, so they wouldn't have all the information you would normally expect on a VAT invoice, but it sets the wheels in motion, and it means that your customers will hopefully agree to pay you, and once they do pay, you can raise an invoice at that point in time. So defer the tax points wherever you possibly can. Just flipping it back a bit, as far as input VAT is concerned, if you are the I guess you're purchasing services, you're the customer effectively, you can go into something called self-billing, which means that you arrange to raise the invoice on behalf of your supplier. And again, that means that you're in control of the arrangement. And we've seen this with a lot of large customers. They have said that we want to go into self-billing, and they then raise the purchase invoice. They claim the VAT back as soon as possible, and they are then in a position to be able to pay the supplier a bit quicker and a bit more promptly than perhaps before. Bad debt relief. If you've got sales that are unpaid, more than 6 months old, you can claim back the bad debt relief on them. And I would encourage you to do that. There's a process to go through, but it's well worth doing, especially if you've got unpaid sales and you've already paid the VAT to HMRC. We're seeing a lot more people, a lot more organisations interested in making claims for overseas VAT. Although we've left the EU, we're in the transition period, you can still make a claim for the VAT you've incurred in other European countries. The cut-off point for those claims is September, but you can make them at any point in time that you want. So again, if you've not done it for a while and you think there's VAT owing to you, claim it. You do need to make them every year, so unfortunately you can't go back for any more than one particular year. Staff expenditure, again, lots of people don't bother claiming the VAT on staff expenditure. They just think it's too much bother than it's worth. If you haven't done it for a while, you can go back for 4 years. If you do it regularly, try and make sure that you get your staff expenditure in, and you might find that you're paying some different expenditure this time. You're maybe allocating some costs for home expenses. Think about the employment tax position, but from a VAT point of view, it is possible to claim some of the VAT. We just have to work out what the apportionments are. And again, if you want to discuss that, more than happy to talk to you about it. If you move on to the next slide, this is moving into the more of the revive period. So this is where we're focusing a lot of our attention now. We've kind of covered all the points I've just mentioned with clients quite a lot so far, and we're now looking ahead to, well, what happens when things start to relax? What happens when we start going back to the office and business starts to pick up again? So in this arrangement, we're kind of looking at things that maybe been aborted. If you started something, but you've decided, you know what, we're not going to do this anymore, we're just not going to pursue this activity or this idea, you may well have VAT that you've incurred on those expenses. Now, on associated expenses, the VAT that you've claimed, as long as you've just aborted your activity, you don't have to do anything with. You can keep it if you've recovered it already. If you haven't recovered it and it was linked to VATable income and activities, you can claim it. If, however, you've changed your intention, and rather than having something that was VATable, you might have something that's exempt, you need to think about repaying VAT to HMRC. So aborting doesn't result in any repayment, but change of intention could. Changing sources of income or differences in values. So we're seeing a bit of change where perhaps grant funding is still being received and other sources of exempt income is still being received, but the trading income, the income that's VATable, the income that normally gives you VAT recovery, is not being received anymore. And that affects VAT recovery calculations. So if you're involved in partial exemption, or you've got non-business activities, or even you've maybe had a capital expense and you have capital goods scheme applying to your business or your organisation, be careful, because if the income sources that you receive have changed in quantity or numerically, your VAT recovery calculations may have changed. And if they have, you may be in a slightly different position than what you thought you were going to be. Fundraising, I've mentioned refunds already, so I'll kind of gloss over that one. Fundraising is interesting, and we've noticed that there's quite a few campaigns, including crowdfunding, and some involve, especially for charities, either a straight donation, which is a donation means that you just people are paying you money and not getting anything specific or measurable in return. And in that case, the income you receive is not subject to VAT because you're not supplying anything, and it should be subject to gift aid as long as you've got all the gift aid forms and documentation in place. When it comes to crowdfunding, though, there's also an element where you may be providing them with benefits, essentially like a membership. And if you do that, you provide something in return for the funding, that may be due on that income. So just, again, be careful. In the ideal world, you would be saying that the benefits have a value attached, and that then ring fences the amount of VAT you have to pay to HMRC, and it could actually mean that you get to claim back VAT on expenses as well. Any element paid above that ring fenced benefit value, you can claim gift aid on. If there's nothing that's kind of donation, gift aid cannot be claimed. Look out for digital activities. Lots of organisations are now doing more and more online. If you are allowing people to download, whether it be sound bites, whether it be video, whether it be information, and they're paying for that download, it could mean that you've got a responsibility and a requirement to account for VAT elsewhere. There's been a really interesting case involving publications. So online publications used to be liable to standard rate VAT, but their paper equivalents, so newspapers, for example, were all zero rated. And a recent case has just found that that's wrong, that really, if you've got a digital equivalent of a newspaper, that should follow the same liability and not be subject to VAT. So it's a tricky area. Double check if you're putting things online and allowing people to download online, double check your position, because it just may mean you've got slightly different VAT responsibilities. Any new services, any new activities, always check the VAT liability of it, always check to make sure you've got the correct liability, I guess, earmarked and budgeted for. And the same, Kirsty was mentioning reorganising business activities and business structures. Again, if you're moving things around, if you've got a VAT group, you can ignore all the movements. If you don't have a VAT group, you need to think about VAT. If you transfer assets from one company to another, you may have to account for VAT on those transfers. Even if no cash is changing hands, there can be deemed supplies and deemed valuations. Final slide for me, if you could pop onto the next one. Again, it's more just a heads up. Lots of clients we're talking about are looking to spread their net wider afield now, and they're looking at more international activities. Again, just think about the VAT position. Also think about if you're going to be supplying goods in another, say, European, but in other countries, you need to think about whether you have a responsibility to register and to account for taxes in that country as well. Building projects, I mentioned before, changes of intention. If your building project has changed and is now, for example, rather than renting out a property, you might want to sell it. Rather than the property being going to be used for, I don't know, domestic accommodation, you might be looking to hire it out as holiday accommodation, or vice versa. Any sorts of changes to your intention, check the VAT position, because your initial VAT position may have changed and it may affect the recovery. It might be good, it might not be so good. A few reminders: charities, if you're buying equipment which have got medical or research links, it may be that you can buy them with no VAT attached. Similarly, if you're buying equipment for disabled people, there are zero ratings and there are exemptions for certain purchases. Advertising for charities, advertising in any medium, you don't have to pay VAT on that as long as you issue a certificate. And again, make sure you kind of ensure that you're not paying VAT unless you really need to. Property rental, where there's any change of tenancy, check out the VAT position. It may be that VAT was previously applied but doesn't have to be. And if you as a charity are changing the terms of your tenancy, it's an opportunity to look at the VAT position. If you're using the building for charitable non-business purposes, you may not have to pay VAT on any rent. Digital publications have been mentioned. And the last one is anybody who's involved with care and welfare services, educational services, or research or cultural activities. The VAT position there is normally those supplies are exempt from VAT. And currently, if those are exempt, you cannot recover the VAT you've incurred in associated costs. We've been seeing quite a few model changes and in some cases structural changes to organisations, and where the specific conditions that are linked to all of those supplies are not met, your activities may change and your VAT position change. So one example, for example, education. If your objectives and your internal policy say that the income from education or profits from education can be used for any activity at all, your educational activities can be VATable, which allow you to recover the VAT on associated costs. Similarly, if you are a cultural body and you've got admission charges, if your organisation doesn't satisfy the cultural exemption rules, so for example, you have someone on the board that gets paid a salary, then you can charge VAT on the income and you can recover the VAT on your expenses. So what we're doing with a lot of clients at the moment is just revisiting their position, taking stock of the next 6 to 12 months and working out what the best VAT recovery and overall VAT position is for them. If anybody is interested in having those sorts of conversations, we're available and we're happy to discuss. That's it. That's the end of my slides.